What's going on, everybody? This is Rob with Raintown Real Estate. Once again, I'm with my buddy Jason Gray with
New American Funding.
New American Funding. Jason was with a different company for a long time, and I always get that confused.
Brain.
So my bad.
No, it's all good. You always laugh about it.
But man, it's good to see you.
Nice to see you too.
Thanks for doing the past 2 classes with me.
No problem.
This is our 3rd class on financing for a rookie class.
Yep.
For all you guys, new agents out there, I think it's really important for you to understand the difference between the most common loans that we see, and that's FHA, VA, USDA, and a conventional loan.
Okay.
So, Jason, today, if you could, I want you to talk about the difference between those 4, why people would choose the different sorts of loans, and really, I want you to tell us about why any of these loans are good. Right? And why any of these loans might be bad. Like if you're
right.
Okay? Can you do that for me?
Yeah, absolutely. Okay.
That way these guys know what to tell their clients out there.
So let's go with FHA. Now, FHA, like we were talking about earlier, is probably not as important here in Washington State because it's not as common, but in most parts of the country it really is. So FHA is a very low down payment program, 3.5% down. And the reason why we usually take a client FHA is because it's credit score. High debt ratios, those are the 2 main factors. So if a client's telling me they have a credit score under a 680, even sometimes a 700, I'm going to say FHA. And the reason why it is Fannie Mae and Freddie Mac, who are conventional loans, really makes you pay the pain if you have low credit scores, both on the rate and on the mortgage insurance. So FHA is a great product. Gift funds are available, really lax on credit, debt ratios, everything. That's a fabulous loan for a lot of people. Now, the most common loan, in my personal opinion, in this market is a conventional loan, which is a Fannie Mae, Freddie Mac loan. Those are the 2 large purchasers of mortgages in the country. They want in between 3 to 5% down. You do not have to put 20% down to get a conventional loan, so don't worry about that. If you're putting less than 20% down, though, you have this monthly mortgage insurance that you have to pay. And so that is, part of the gig, and credit score driven on those products, right? You have an over 700 credit score, have 5% to put down. Those are great. Those are fabulous loans for people. Now, Fannie Mae and Freddie Mac recently have made a bunch of changes based on credit scores, loan to value issues, just a lot of that stuff. You have a condo or a house. So there's a lot of little factors coming into play for me, and it's my responsibility to sort of tell the client, this is the reason why I think you need to go to this particular loan and why it's benefiting you and why this other one's not benefiting you. So if I can have them go conventional, that's ideal. Now, let's talk about a VA loan, a veteran loan. VA loans are fabulous, right? Even if you have a down payment or not, because one of the questions I always ask the veteran is, do you have 10% disability or not? Because if they have 10% disability, they don't pay the funding fee that they pay up front. And on all VA loans, there's no monthly mortgage insurance. And usually the rate is really good on a VA loan on top of it. So if they're a veteran, it's a fabulous, fabulous loan for a veteran. And, there's no loan limits on VA loans, by the way.
There's none.
You can go $8 million. You're a disabled vet. You have no funding fees.
I'm going to join the Army right now.
Right, might as well.
Let's
4
go.
years. Let's go. All right. So the next one would be like a USDA loan. Now, a USDA loan is homes that are in pocket areas that are not close to the city. So you think of Seattle, right? And you think of anything from Highway 18 East, or you go all the way up to Marysville North, or you go down south. It's really on the outskirt areas. The tough thing about this loan, this loan, by the way, if you have no money down, if you can go in this loan, this is the best loan to go with because the monthly mortgage insurance is really low. The upfront funding fee is really low. The only strict thing is they're very strict on income. If you have 3 kids or more, they're not quite as strict, but they're very strict on the debt to income ratios. The front end ratio can't be any higher than 31%, and the back end ratio can't be higher than 40%. I mean, it's crazy.
These guys all know what front end and back end ratios are.
Yeah.
We'll figure
We'll
that
figure that out later, right?
Yeah.
So keep that in mind. They're very strict on the debt ratios, but they don't want to get them overextended. They're giving them $200,000, $300,000, $400,000, $500,000 with no money down. Are you going to give your $400,000 or $500,000 with no money down and take all the risk?
Yeah, USDA is the bomb. If you can do it, if you're in the right area, the right income, right home, it's the bomb. But we don't see them that much.
Right, you don't see them that much. But like conventional loans, you need a minimum 620 credit scores. But really, I'm not going to get them into that loan unless it's 680. But FHA, VA, and conventional, I can go down to 580 credit scores. Some people can go even lower than that, right?
Which is insane.
But so USDA, fabulous loan in the outskirts. trust me, if the clients are looking in those areas, that's a conversation I'm having for sure. There's no doubt about it.
It's a great deal.
Yeah,
it's a great deal. It's
great
the
deal.
cheapest way to go in that
100%.
situation.
Yeah, exactly.
Right.
So let's talk about the next loans, DPA loans. So
Okay.
DPA loans are really, really good loans. I don't care if you got no money to put down. If you get into home ownership, it's the best thing you can always do. I'd rather you be into something that has a little bit higher interest rate, that's not quite the best loan possible, but you're building equity in homes.
Yeah.
You're building a 5% equity every year on this house. I can refinance them out of the particular type of loan. No matter what, home ownership is the best way to building wealth for themselves.
Without a doubt.
So it's one of those best loans. Now, so that's the next loan. Let's just talk about two other type of loans. You got jumbo loans, right? So jumbo loans are where the conforming loan limit only goes to X amount of dollars, which in King County is $977,500 is the max.
As of today.
As of today. Now the max, if you have to go by that, you're going into the jumbo category. Jumbo loans are strict on debt ratios as well and credit scores. So you got to be careful with those, and they usually want 20% down. There are some 10% down programs available. Let's talk about the last one, stated income loans.
Sure.
They're not really stated. They're asking for either 1-year tax returns or 12 months business or personal bank statements, and we give them a percentage of that. So those are really good loans as well. The true stated income loans are gone, right? But there's some other bank statement loans that are out there. They require a larger down payment, usually 25% down. The rates are a little higher for the risk factor. But again, get into home ownership, giving them the plan on how to refinance out of it at a later date when they have a better financial situation. But in the meantime, get them into a house, let them get that 5% appreciation per year and build their wealth somehow. Never tell them no.
I agree.
Yep.
I agree.
And if there's a credit situation, what can we do to either get them in a house, or what do we need to do in the next 4 to 6 to 12 months to give them a timeline? Say, hey, Rob, I can get you a house by Christmas.
Yeah, they fix it.
But you need
Let's
to do
fix
this.
it.
Right. Let's just come up with a plan. So even though if you think someone doesn't qualify, it's okay. Let's give them a plan. Let's try to figure out what type of program we can get them into eventually.
Curveball.
Yeah, curveball.
What's an I-10?
I-10. So it's a person that doesn't have a legal Social Security number, but they have a right to work in the state with this I-10 and information. I-10 loans are difficult. Fannie Mae came out with a program that you thought was going to work, but you can't get the documentation that Fannie Mae needs. So it's like a nothing burger. But if you have 20 or 30% down and we pull an I-10 and you pull the credit, they'll come back and say, hey, you can have this loan and you got X amount of percentage and rate and put this money down. There are still possibilities. You know, you have someone living in China want to buy a house, they can still buy a house here.
We've closed deals like this, Jason.
40% down.
We've closed deals.
Right? Yep. You just got to give me the opportunity to talk to them and figure out the solution. And if they say no, that's a different story. But there are plenty of loan programs out there for people. I just closed a loan for this lady. She had $18,000 in income, going through a divorce, got a hard money loan for her. She's going to need it for a couple months, and she's going to go ahead and cash that thing out really, really fast when her divorce finalizes.
Yeah. Hard money loan's another one, but we'll talk about that another day.
That's a whole nother beast.
Have you ever had a loan be assumed?
So I've never personally done one, but you can only assume government loans. And
So any loan that ends in an A.
Correct. Anything that owns it.
The USDA,
Yep.
VA,
Yep.
FHA.
That's right. Exactly. There's requirements on that. Great if
Hard money loan's another one, but we'll talk about that another day.
that's a whole nother beast.
Have you ever had a loan be assumed?
So I've never personally done one, but you can only assume government loans. And
So any loan that ends in an A.
correct. Anything that owns it.
The USDA,
Yep.
VA,
Yep.
FHA.
That's right. Exactly. There's requirements on that. Great if there's not a lot of equity in the house, but the hard thing is if you get into an FHA loan and you're assuming it, they only owe $200,000 in the house, but it's worth $400,000, right? But this guy's got a 2% interest rate here. How do you make up the extra $200,000?
How about you use a HELOC?
You could try to use a HELOC, something like that, right? So you got to get really creative. There is some capital that you have to put up front to make that assumable, to make up the gap difference of that loan amount versus what their asking price is.
What's an 80-10-10?
Oh, so 80. What are you doing here? All right, so
We're just throwing out some options.
Perfect.
That way, when he's totally screwed up your mind, we're going to screw it up a little bit more.
That's right. So an
This is
80
a class. It's going to be tested later.
So an 80-10-10 loan is an 80% first mortgage with a 10% second mortgage, and you're putting 10% of your own money down. Why are you doing this? To avoid the monthly mortgage insurance. Those loans are really good when the HELOC interest rates are pretty good. Right now, they're not amazing, but there is a purpose for that type of loan. The purpose could be as I'm doing a 75-15-10 loan because I need to get the conforming loan limit on the first, because they only want to put 10% down and put a 15% second because they bought a $1.2 million house and they don't have the money to put down.
Now, the reason I asked that, Jason, is because so many times the real estate agent knows just enough get everyone in trouble.
True.
And there's ways to get through these things that a good mortgage professional will know.
Yes.
Right? Someone says, well, I don't want to have a jumbo.
Right.
Don't want to have to do a jumbo. I don't have to worry about that.
Right.
Well,
80-10-10.
sometimes you do an 80-10-10, 75-15-10, or whatever it is.
Yeah.
So you can change that.
Yep.
Last question, I promise.
No, you can ask me if you want.
Again?
Yeah.
Cool.
Okay.
I won't. Is mortgage insurance is it just bad?
No. So mortgage insurance is a guarantee to the lender that if you default on the loan, that they get a percentage of their money back. Just remember, on a conventional loan, you can eliminate mortgage insurance if you've been in the house for 2 years, you made your payments on time, and you have 20% equity in the home. Okay? So you can get rid of it. Now, we service all of our loans here, so it's easier for us to get out of it a little sooner if we need to. Now, most lenders, though, that 2-year requirement's there. FHA loans, you always have to refinance to get out of mortgage insurance. There's no way of eliminating it anymore. So I need to be strategic with that client and say, what can I do to get you to a conventional loan when we refinance? That's going to be really a key.
80-10-10.
80-10 or 80-10-10 is right. Exactly. So all these programs have purposes, and there's always a plan around things. I never want to get on the phone call, and I never want to put you in the position on a phone call where I say no. I want to say, I can't do it now, but, or we can do this, but, or whatever it is. Yeah. Most of the time they qualify for everything that we put in front of them. But there's that situation where I want to build that pipeline for you in the future. So we need to have a plan that's going there. And I highly encourage you, if you're not working with me, work with someone who's been doing this longer than 5 years. Look at their history, see how long they've been doing this, make sure they're doing volume, because you don't want to rely upon your paycheck on someone who's brand new in this business.
One thing I just want to stress here regarding that, it's so important. A lot of times people come to me and say, well, they didn't get qualified for a loan. And it's because they talked to a loan officer who was inexperienced or wasn't creative.
Yeah.
What I mean by creative, I don't mean like illegal. What I mean is creative, like they know what to do in order to make something happen.
Exactly.
What to pay off. What sort of loan to do. What can we do to make this happen? What happens if we pay off a bill? What if we do this?
Right.
There's literally hundreds of ways that we've done to make deals happen.
And there's sometimes I have a brain fart on something, and I go, Rob, man, we got this deal. What are you thinking? And Rob knows enough to be dangerous, like most of you do as well. There's usually some type of solution here that, sometimes I make mistakes where I don't see it all the time, and Rob goes, gosh, what about this? And so communication between all of us collectively can create those things to sort of start thinking. But for the most part, we usually have everything dialed in, but we'll vet this thing out all the way to the end.
Yeah. And just because someone said no to your client doesn't mean that everyone's going to say no.
True.
Right?
Yeah.
I don't know why, but BECU is never getting me a loan for anything. They hate me.
They don't hate you.
They hate me.
They don't hate you.
That's guy, I hate him back.
Okay.
No big deal. I don't hate him back. But you know what I mean. I don't like him saying no.
Yeah.
But sometimes just the type of loan you're doing doesn't get along with a certain bank.
I would rather you guys give me a call. They spoke with another bank. I said, just give Jason an opportunity to speak with you for 5 or 10 minutes. Then I can be honest with you and say, Rob, that's a dead deal. Mm-hmm. It's okay to say it's a dead deal, and then it is. But at the very end of that call with that client, even though it was a dead deal, I want to give them a solution how to get to that goal for themselves, some way, way or the other. It might be I had this really nice lady I spoke to. There's no way she qualified for anything. And I said, you need to move to Ritzville.
Yeah.
She goes, what? And I go, you're retired. This is great. You can buy a house. It's $140,000. She goes, I'd love to. Buys a house in Ritzville.
Mm-hmm. Missouri.
50,000. Exactly. Yeah.
Yeah.
So
well,
there's solutions.
Now you guys figured out everything there is to know about a loan. Not really.
You're
dangerous. But at least you know the different styles of loans. You know some of the reasons why you might use one, some of the reasons why you wouldn't. But it's always good to talk to your loan officer to make sure your clients are getting the right thing.
Correct.
Nothing wrong with getting a second opinion. I do that all the time. Someone comes in with an outside lender, I always say maybe we need a second opinion.
Yep.
I don't know that guy. It's my job to make sure my client's taken care of. Second opinion is super important. Make sure you take care of your client, number one. All right? Appreciate y'all.
Thank you.
Thanks for showing up to the rookie classes. Rob with Raintown. I'm out. This is my partner, Jason, over here.
Yes. Call me if you have any questions.
New American Funding. What's your phone number?
425-260-3482.
And you better know my phone number. All right, guys. Peace out.
Bye.
Good to see you.